A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
You know, Corn, this whole show runs on GPU compute, and we wouldn't be here without Modal.
Seriously. And that's what powers all our text-to-speech. Everything you're hearing right now.
They're an AI infrastructure platform. Developers use them to run GPU workloads in the cloud with zero infrastructure headaches.
If you're building anything with AI, check them out. Modal.com. Imagine a world where a company's worth has absolutely nothing to do with the gold in its vaults or the bricks in its warehouse, but centers entirely on the collective mood of 10,000 strangers trading digital slips of paper. It is a bit of a localized hallucination that we have all agreed to call reality.
It is the ultimate social contract, Corn. We have moved from valuing things based on what they can physically do to valuing them based on what we collectively believe they will do in the future. In 2026, with global market capitalization sitting somewhere north of $110 trillion, that collective belief is essentially the engine of the entire planet.
Today's prompt from Daniel is asking us to trace that engine back to the first time someone cranked the handle. He wants to know about the history of publicly traded companies, how many exchanges are actually out there running the world, and when we first decided that a company's value should fluctuate like the weather. By the way, fun fact for the listeners, today's episode is actually being powered by Google Gemini 3 Flash. It is writing the script while we provide the, brotherly gravitas.
Or the nerdy deep dives in my case. Daniel is hitting on a fundamental shift in human history here. We take the stock market for granted now, but the idea that you could own a tiny transferable piece of a massive enterprise without actually having to show up and work there? That was a radical, world-changing invention. It changed the nature of risk forever.
It's basically the original crowdsourcing. Instead of one king or one massive merchant funding a voyage, you get 1,000 people to chip in a few guilders. But before we get to the Dutch and their ships, let's look at the sheer scale of this today. Daniel asked how many exchanges there are. I think most people could name the New York Stock Exchange and the Nasdaq, maybe the London Stock Exchange if they're feeling worldly. But what's the actual count?
It is significantly higher than most people realize. According to the World Federation of Exchanges, there are over 200 prominent stock exchanges operating globally right now. If you count every smaller regional exchange and specialized electronic platform, the number climbs even higher. You have the giants like the New York Stock Exchange and Nasdaq, which obviously dominate in terms of market cap, but then you have massive players like the Shanghai Stock Exchange, the Euronext, and the Tokyo Stock Exchange.
200? That feels like a lot of redundant infrastructure. Why do we need a local exchange in every corner of the globe when everything is digital anyway? Is it just national pride? Or is there a functional reason to have a stock exchange in, say, Bermuda or Nairobi?
It is a mix of both, but mostly it comes down to regulation and local capital. Every country wants a mechanism to funnel domestic savings into domestic businesses. If you are a mid-sized manufacturing firm in Vietnam, you might not have the scale or the regulatory stomach to list on the New York Stock Exchange. You need a local venue where local investors understand your business model and where the reporting requirements are tailored to your legal system. Plus, there is the time zone factor. Liquidity tends to pool where people are awake.
Fair enough. I suppose the sun never sets on the stock market is a literal truth. But let's go back to the when. When did this start? Because I'm guessing ancient Romans weren't checking their tickers for olive oil futures.
Actually, the Romans had something called the Societas Publicanorum, which were sort of proto-corporations that performed government contracts and people could own shares in them. But those weren't really market-dictated in the way we think of it. To find the birth of the modern fluctuating market, we have to go to Amsterdam in 1602.
1602. The Dutch East India Company. The VOC, as the cool kids of the 17th century called it.
Well, not exactly, because I'm not allowed to say that word, but you are spot on. The Dutch East India Company was the first company in history to issue bonds and shares of stock to the general public. Before this, if you wanted to fund a trading voyage to the Spice Islands, you formed a partnership for that specific voyage. When the ship came back, you sold the pepper, split the profits, and the company ceased to exist.
High risk, high reward, and a very short shelf life.
Right. But the Dutch realized that if they wanted to build a permanent empire, they needed permanent capital, so they created a company that would last indefinitely. They issued shares that didn't just represent a claim on one ship, but a claim on the entire enterprise. And here is the kicker. They made those shares transferable.
And that is the moment the market is born. Because if I own a share and I need cash today, but the ship isn't coming back for 3 years, I have to find someone to buy my share. And that person is going to ask, well, what's it worth?
And that is where the fluctuating value comes in. The Amsterdam Stock Exchange was established specifically to facilitate this trading. It wasn't a fancy building at first, it was an open-air bridge. People would gather there and haggle over the price of VOC shares based on the latest rumors. If a rumor hit the bridge that a ship had been lost at sea or that a new spice route had been discovered, the price would move instantly.
It's wild to think that the mechanics of a modern hedge fund are basically just a high-tech version of guys standing on a bridge in Amsterdam shouting about nutmeg.
It really is. The VOC initial public offering raised about 6.5 million guilders. In today's money, adjusting for purchasing power and the scale of the economy, that is roughly $7.8 billion. It was a massive injection of capital that allowed a tiny nation like the Netherlands to become a global superpower. But it also created the first recorded speculative bubble.
Ah, the tulips. I knew we'd get to the flowers.
Tulip mania in 1637 is the classic example, though it's worth noting that tulips weren't traded on the official exchange in the same way stocks were. They were traded in taverns. But the mindset was the same, the idea that the value of an object isn't its utility, but its resale potential. At the peak of the mania, a single tulip bulb, specifically the Semper Augustus, could sell for 10 times the annual salary of a skilled craftsman.
I feel like there's a lesson there for some of the weirder corners of the tech market today. But let's look at the technical side of that early trading. How did they actually settle a trade? There were no computers, no central clearinghouses. If I sell you my share on a bridge in 1610, how does the company know I don't own it anymore?
It was incredibly labor-intensive. You had physical share certificates, but the real source of truth was the company's ledger. To finalize a trade, the buyer and the seller usually had to go to the company's headquarters, the East India House, and have the bookkeeper manually cross out one name and write in the other. This created a natural limit on high-frequency trading. You couldn't exactly do 1,000 trades a second when you had to wait for a guy with a quill pen to update a giant leather-bound book.
I'm imagining a 17th century version of a server crash being the bookkeeper running out of ink. But this concept of limited liability is also huge here, right? Because if the company's ships sink and they owe a bunch of people money, those creditors can't come after my house just because I own one share.
That is the secret sauce of capitalism, corn. Limited liability changed the risk-reward calculus for the average person. Before that, if you were a partner in a business and it went bust, you were personally responsible for every penny of debt. You could end up in debtor's prison. With the joint stock model, the most you can lose is the amount you invested. That protection is what allowed capital to aggregate from thousands of small investors, which is how you fund things like railroads or, eventually, semiconductor fabs.
So we have the Dutch setting the stage. But the New York Stock Exchange is the one everyone looks to now. How did we get from Amsterdam to Wall Street? Was it just the British taking the idea and running with it first?
Pretty much. The London Stock Exchange formalized things in 1801, but they had been trading in coffee houses for a century before that. Jonathan's Coffee House was the big one, but the New York story is actually very specific. It starts in 1792 with something called the Buttonwood Agreement.
Named after a tree, right?
Well, again, I can't say that word, but yes. 24 stockbrokers signed a 2-sentence agreement under a buttonwood tree on Wall Street. They were basically forming a guild. They agreed to only trade with each other and to charge a fixed commission. It was a response to the first financial panic in U.S. history, which had happened earlier that year. They wanted to create a closed loop of trust so they wouldn't get wiped out by shady dealers.
It's funny how every major advancement in market structure seems to be a reaction to a massive disaster. We break something, we realize we need a rule to stop it from breaking that way again, and then we find a new, more creative way to break it.
That is the cycle. The New York Stock Exchange grew because it became the primary place to trade government debt from the Revolutionary War and, later, shares of the first banks. But it really exploded with the railroads in the mid-19th century. Railroads required more capital than any single bank could provide. You needed the public. The NYSE provided the liquidity that made the Industrial Revolution possible in America.
So, we've gone from quills and ledgers to the buttonwood tree. Now let's jump to the modern era. When did it stop being about guys in suits shouting on a floor and start being about servers in New Jersey?
The transition started in the 1960s with the first computerized price tickers, but the real shift was the launch of NASDAQ in 1971. NASDAQ was the world's first electronic stock market. It didn't have a physical trading floor, it was just a network of computers. At first, people thought it was a joke, a second-tier market for companies that weren't good enough for the NYSE.
And then Apple and Microsoft showed up, and suddenly the electronic market didn't look so second tier anymore.
Precisely. The NYSE held on to its floor trading for a long time. They still have a version of it today for the cameras, but by the late 90s and early 2000s, the vast majority of the volume shifted to electronic communication networks, or ECNs. This led to the rise of algorithmic trading. Once the market is just a stream of data bits, you can write a program to react to that data in microseconds.
Which brings up a question about market-dictated value. If the market is now 70% bots trading with other bots, is the price of a stock still reflecting the value of the company? Or is it just reflecting the physics of the algorithm?
That is the million-dollar question. Well, the $110 trillion question. In theory, the bots are still looking for alpha, which means they are looking for cases where the price doesn't match the reality. If a company announces a breakthrough in battery tech, the bots buy because they know the future value is higher. But the second-order effect is that you get these flash crashes.
Like the 1987 Black Monday crash, or the more recent ones.
Black Monday was a huge turning point. The Dow Jones dropped 22.6% in a single day. A lot of that was driven by programmed trading, early algorithms that were designed to sell as the price dropped to protect portfolios. But when everyone's computer is programmed to sell at the same time, the bottom just falls out. There's no human at the other end saying, wait, this is insane, Apple is still a good company.
It's the digital version of a stampede. But what I find fascinating is that despite all this high-speed globalism, we still have these 200-plus regional exchanges. Why hasn't the world just consolidated into one giant global stock exchange?
A few reasons. One is regulatory arbitrage. Different countries have different rules about what a company has to disclose. If you're a tech startup in Tel Aviv, you might list on the Tel Aviv Stock Exchange first because the requirements are easier to meet than the NYSE. Another reason is sovereign ego. A stock exchange is like an airline. Every country wants one because it's a symbol of economic maturity.
It's a bit like having a fancy stadium. It says we're open for business, but what about the shift to private markets? I was reading some of those notes Daniel sent over, and it mentioned that the 55 largest private companies in the world now have a combined valuation of $2.8 trillion. Are we seeing a reversal where companies are staying private longer to avoid the fluctuating market headache?
We definitely are. That is a major trend in 2026. In the 90s, a company like Amazon went public very early in its life cycle. Today, companies like SpaceX or ByteDance stay private for a decade or more. They raise billions from private equity and venture capital instead of the public. This means the fluctuating market value is replaced by occasional valuation rounds. It keeps the founders in control, but it also means the average retail investor, the guy on the 17th century bridge, is locked out of the biggest growth phases.
So we've democratized the trading of mature companies, but the real wealth creation is moving back behind closed doors. It's almost like we're heading back to the pre-VOC era of private partnerships, just with way more zeros involved.
In a way, yes. But then you have the counter trend, tokenization. There is a lot of talk right now about tokenized real-world assets. The idea is that you could take a private company, or even a piece of real estate, and break it into digital tokens that trade on a blockchain-based exchange 24/7.
Which would mean the market never sleeps and the fluctuations never stop. I'm not sure if that sounds like a utopia or a nightmare. Imagine your house's value ticking up and down on a screen in your kitchen, based on a rumor about a new Starbucks 3 blocks away.
That is where the technology is pushing us. We are moving toward a world of total liquidity, where everything has a real-time market price. But we have to ask, does that actually make the economy better? Or does it just turn us all into frantic day traders of our own lives?
I think I prefer the guy with the quill pen. At least he had to take a lunch break. But let's get practical here for a second. If someone is listening to this and they want to understand how these 200 plus exchanges affect them, what's the takeaway?
The first takeaway is that the market is not a monolith. If you are looking at a stock, you need to know where it's listed and what the liquidity is like on that specific exchange. For example, a dual-listed company, one that trades in London and New York, might have a price gap between the two exchanges because of currency fluctuations or local news. Smart traders look for those anomalies.
It's called arbitrage, right? Buying it cheap in one place and selling it dear in another?
Well, no, I didn't say it, but yes, that's what it is. For an entrepreneur, the takeaway is that the where of your listing matters as much as the when. If you are a green energy company, listing on a European exchange might give you a better valuation because there is more green capital concentrated there. The market isn't just a machine, it's a collection of people with specific biases and interests.
And for the average person, I guess the lesson is that value is a very fragile thing. It's based on consensus. If the consensus changes, if people decide that a certain tech sector is overhyped, the value can vanish in a flash, literally.
That is, the fluctuating part Daniel asked about. It began in Amsterdam as a way to manage the risk of spice ships, and it has evolved into a global nervous system. What's wild is that we've reached a point where the stock market often has more influence on a country's policy than its own citizens do. If the bond vigilantes decide they don't like a government's budget, they can tank the currency and force a change in leadership.
The market is the ultimate voter. It votes with its wallet every millisecond. Speaking of milliseconds, we should probably touch on the scale of global market cap again. $110 trillion. That is a number so big it basically becomes abstract. It's about 4 times the size of the entire US GDP.
It shows how much of our wealth is imaginary, in the sense that it's based on future expectations. If everyone tried to cash out of the global stock market tomorrow, that 110 trillion would collapse to a fraction of that, because there isn't enough actual currency in existence to buy all those shares. The system only works as long as we all agree to stay in the game.
It's a giant global game of don't be the last one holding the bag. But it's also the reason we have airplanes and smartphones and life-saving drugs. Without the ability to aggregate that capital and share that risk, we'd still be waiting for one rich king to decide he wants to fund a project.
This is why I find the history so fascinating. It's not just about money, it's about the evolution of human cooperation. The stock exchange is a piece of social technology. It's a way for strangers who don't trust each other to work toward a common goal because their interests are aligned by a fluctuating price.
Even if those strangers are now mostly silicon-based algorithms running in a server farm in Northern Virginia.
Well, the algorithms are just the latest version of the quill pen. They are still executing the will of people, or at least the goals those people set. The question for the next decade is whether we lose control of that market-dictated value entirely. If AI starts creating companies and other AIs start trading them, do humans even need to be in the loop?
That sounds like a prompt for another day. My weird prompts, the all-AI economy. I'm sure Daniel is already typing it up.
I wouldn't put it past him. But for now, the takeaway is clear. We live in a world built on the foundation laid by those Dutch merchants on a bridge. We've just added a lot more layers of math and fiber optic cable on top of it.
And more exchanges. Don't forget the 200 exchanges. I'm still stuck on that. I feel like I need to go find a map and spot all of them. Is there one in Antarctica? The Penguin Exchange?
Not yet, but give it time. With global warming, the real estate market there might be the next big bubble.
I'll start saving my guilders now. This has been a deep dive, Herman. I think we covered the how, the when, and the how many.
I think so too. It's a complex system, but at its heart, it's just people and bots trying to figure out what the future is worth. And the answer, as we've seen, changes every second.
Thanks as always to our producer, Hilbert Flumingtop, for keeping the gears turning while we talk about the gears of global finance.
And a big thanks to Modal for providing the GPU credits that power the generation of this show. We couldn't do these deep dives without that infrastructure.
If you want to dive deeper into the weeds of history or tech, find us at myweirdprompts.com. You can find the RSS feed there and all the ways to subscribe so you never miss a prompt.
This has been My Weird Prompts. We will see you next time.
Unless the market crashes and we have to go back to being actual sloths and donkeys.
I think I'd be okay with that. More time for reading.
See, this episode was produced using Google Gemini 3 Flash, text-to-speech by Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from slow takes to